Good afternoon, everybody. This is Wes Cleckley with Interlink Mortgage. This is our first live update on Facebook in almost 2 months, Corinne, I believe. We shut it down during the holidays, got through that and the crazy end of the year. And there is just so much information out there that I've been needing to share that I probably should have shared before today because this could take a little while, but I'll be as fast as possible. Hope you guys are doing well. For those of you in the industry, I hope this year is getting off to a great start. And gosh, this has been we had just had a January, the whole industry just had a January unlike any other January that I can remember, and I've done it for 18 years. So this is going to remain a hot market this year, and that's mainly what I'm going to talk about. So for those of you that are in this industry, that are real estate agents or builders, even you that are past clients or just folks that know us and that subscribe to our page, this affects everybody. You either own a house or you rent a house. So the housing market is one of the biggest pieces of our economy, and it's super important for you to have a little bit of understanding. So I'm going to share a lot of information today that I got from sources. One of the big sources I get my information from is something we subscribe to on a daily basis, and that is Barry Habib's MBS Highway. So it just gives overall information on the housing market, mortgage rates, the stock market, you name it. So it's great info. I'll share a little bit of that with you today. But I first want to stop and say congratulations to Miles Harris. Today is his 5-year anniversary here at Interlink Mortgage on my team. He is my team lead. He has been an awesome asset. Miles, thank you for your 5 years of service here, your leadership, your dedication, your hard work. Proud to have you, man. Also, on this same day, my baby girl, Michaela, turns 11 years old. So happy birthday. I don't know why 11 seems so much older than 10, but I know 10 was double digits too, but just 11 seems old. But happy birthday to you. You're so full of energy and passionate about everything you do, whether it's horses or volleyball or just anything in life. So happy birthday. All right, let's get on with the show. So again, this crazy, crazy market leads us to, so many people are asking, are we in a bubble? Home prices are going up year over year. The demand is so high. So naturally, the first thing people ask is, are we in a housing bubble? We had a housing bubble and it crashed in 2008. But I'm going to give you some of the differences of what makes today different than back then. Okay. But just as far as this crazy market, I got some stats for you. And this is just in the last 7 days. This is based off the MLS stats in San Antonio. In the last 7 days, 917 new listings hit the market in the last 7 days, but 1,013 went under pending sales. So that means we're selling more got sold or went under contract in pending status than actually went on the market in the last 7 days. Now I realize it's just a 1 week's period, but that's kind of the market we're in. I talked to so many agents. I was talking to Kevin Rogers with 43 Realty. He gave me these stats. I was talking to him yesterday. He's like, man, in some of these price points, and I don't even know what to do. We're offering overprice. We're not even asking for this or this. I mean, it's crazy and still not winning these offers. And I know all of you are in that same situation. You may not even be a real estate agent or a builder, but maybe you're trying to buy one yourself and you've been in all these competitive situations. So if you are in this situation, haven't won it yet, give me a call. I'll be glad to help you with it. If you're a real estate agent or a buyer, there's some tactics you can do to try to make your offer a little bit stronger, and I'll be glad to help with that. All right, so what is the difference between now and 2008? Well, back in 2006, there was approximately 3.5 million units in inventory. Okay, the builders are just going crazy. I mean, the market was on fire. A big part of that was just the crazy financing that was available back then. I got in the business in 2002, so I know about all the products that were available in the early 2000s. I mean, there was stated income up to 100% financing, and you could have a 600 score, maybe even a 580. And they were all adjustable rates. I mean, all this subprime stuff you've all probably heard about, but that helped the problem, but there was just so much inventory. And also, in addition to that, there was a lot less home buyers today in that range. So the median age of the home buyer is 33 years, right? So let me just go back to the inventory. So about 3.5 million units back in 2006. Today it's just over a million, or right around a million. All right, so don't quote me on these exact numbers. I'm doing a lot of this from memory and all these wonderful notes that Corinne gave me. It's a book here, so I'm going to be very concise. So if I mess something up, feel free to put it in the comments. You're not going to hurt my feelings. Or if you have a question on anything, please comment. We'll be glad to answer some questions at the end of this. But let me go back to the median buying age of 33 years. So it just so happened that in 1973, now these are, people don't think about all this stuff, but in 1973 is when abortion became legal. So 1973 through 76, actually the birth rate went way down. Well, that puts, you add 33 years to all those, from 1973 to 1976, that puts you into that early 2000, mid 2000 range. So you had a whole lot more inventory out there than you do today, and then you had a lot less potential buyers in that median home range, or median buying range, or age rather. Okay, so contrast that with back in, let's see, where's the stat, Corinne? So 1988, 89, 90, 91, you actually had an explosion of birth rate. I don't know why, but you can go back and look at charts. You can look it up. Look at the charts of the birth rates. And in those years, we had an explosion of birth rates, right? So you add 33 years of that, that puts it right now, that median age of 33 years old is happening right now. So there's a whole lot more buyers out there on the market today with a lot less inventory. So that's one of the main differences between now and 2008, because as long as demand outweighs supply, there will not be a bubble. Now, is this going to catch up with us one day? Yeah, it probably will. Is it going to be a crash back like we had back in 2008, 2007, 2009? I don't think so. We don't have all the underlying problems with the financing issues and all that kind of stuff, right? But will we essentially plateau out, maybe even pull back a little bit? We definitely could. Real estate is a great investment long term, no matter what. Eventually, long term, it'll always go up. So I'm still a firm believer on it. If you haven't bought today, then you might want to buy now, because home prices will continue to go up. Don't look for them to peel back anytime soon. Not this year, probably not even next year, because again, the supply is not catching up with the demand. All right, so you couple that, because I talk about it all the time with my agents and friends, and on these live updates. Back in COVID, nobody expected the demand to go up. So a lot of that, we always talk about, well, people want more space. They want to finally go buy something for the first time versus rent, or they want more space. They want to move out to the suburbs or out to the country just because they're locked in at home because of COVID. Now they're working from home. They want more space and want their own house. So that was part of it as well. But you also have a lot more buyers out there with less inventory. 2020, with the COVID, exacerbated the problem because the home builders, new homes weren't able to keep up and stay on the pace that they should have, because a lot of parts in the country, home building shut down or slowed greatly. Even here in San Antonio and in Texas, there were months there where things shut down or slowed down. And supply chain slowed down as well. I mean, all the materials and stuff got affected because people couldn't work. So that just made the problem even worse, and we're right in the middle of it. That's why it is hard to get under contract on something right now. But don't give up, because we get contracts coming in every day. So keep up the fight. Just be prepared that you're going to have to make multiple offers on probably multiple different properties. All right, I'll throw this in there too. If you haven't got pre-approved, even if I'm not doing your loan, if you haven't got pre-approved, do it first, because you can't go see a house today and want to make an offer on it and then decide to go get pre-approved. The house will be gone for sure. All right, where does that leave us here? Hey, here's a couple other things why there's more buyers out there. Not just that median age of 33%, but what happened last year with all the issues with COVID and long-term care facilities. A lot of your elderly people that would normally be moving into some long-term care facilities and putting that house on the market are staying in their home for obvious reasons. I would as well. I wouldn't go into a nursing home or long-term care facility if I could help it, right? I would want to stay in my house. So that's happening all across the nation. So that's also tightening up supply. And also, people are staying in their house longer. We used to use the stat of everybody stayed in their house about 7 years. It's actually gone up to about 13 years. Now, that ebbs and flows from year to year. But right now, people are staying in their houses longer. Right? That's also hurting the problem. Zillow has made another prediction this year. Again, I'm talking about this hot market. They have made a bold prediction that home sales will increase 21% year over year. So there's approximately 5.6 million units sold in 2020, and they predict almost 7 million for 2021. So anyway, I could go on and on about this hot market. You know it, but I just wanted to give you some reasons why that's happening. Now, here's the other question that people are worried about in this market. They're worried about affordability, because depending on what news source you listen to, there's people out there that are saying, oh, don't buy right now because affordability is down. meaning you can't buy as much house as you used to. It's not true. It's absolutely not true. I'm gonna break it down to some numbers here. So one thing they focus on a lot of time is the median sales price instead of the average appreciation. All right. So median sales price is not the same thing as average price or the mean. Median simply means that half of them are sold below that price, half of them are sold above. The reason that the median sales price is going up because more houses are being sold at a higher price because the inventory is so tight on the lower sales prices. So you have to focus on appreciation. Now I'm just going to give national stats because that's what I was looking up this morning. On average, the national appreciation is about 7%. So people think, wow, home prices are going up really, really high. That's really, really hot. So affordability is down. Well, here's the key. Wages are actually up. And you can't just look at hourly wages, all right? Because they'll give you the stat of hourly wages. You actually have to look at weekly earnings. Because it's one thing for hourly wages to go up. I think that's gone up about 4% year over year. But if you look at weekly earnings, which factors in overtime, weekly earnings are actually up on average, this is nationwide, of 6%. Okay? So you're sitting there thinking, well, all right, hourly earnings are up 6%, or weekly earnings are up 6%, but appreciation is up 7%. That means affordability is down. That's not true. Here's why. You don't use all of your income to pay for your mortgage. All right? It's usually about a fifth or a quarter of your income to go to principal and interest. So let's just use a simple example. If your income is $5,000 a month and your principal and interest on your mortgage is $1,000, and appreciation went up 7% year over year, so you can figure that now your mortgage payment instead of $1,000 it'd be $1,070. All right, so your income would only have to increase from $5,000 to $5,070 to be at an even affordability, right? So if you actually look at that, that's only a 1.4% increase in weekly earnings, when in actuality it's about 6% overall. Now this is average. So actually affordability is up just off that stat alone. That's if interest rates were flat. Affordability is actually up because earnings are up. But when you throw in last year, when year over year rates were up or down about 1%, it just added fuel to the flame. All right, so affordability is actually quite a bit higher now. In fact, we're in one of the seventh best affordability periods of all time. So don't listen to those people that tell you not to buy because affordability is not there. It is definitely there. It's one of the most affordable times to buy a house and take advantage of rates. Look, rates are down in the 2s to 3s depending on where you qualify, what program you're doing, what term you're doing. So look, if you haven't bought yet, you're thinking about it, kicking the tires, give us a call. Let's get you an idea of what you qualify for and then get you with a great agent to start looking. All right. Or if you haven't, better yet, if you decided to be one of the folks that are going to stay in their house longer for 13 years or more, and you decide you're not going to move, and you haven't taken advantage of the rates to refinance, call me. It may make sense for you, it may not, but I'll at least look at it and tell you what, give you my opinion. If it doesn't work out, no problem. At least you know. All right, and you didn't miss out on the opportunity to get something at record lows. All right. So where does that leave us, Corinne? All right. So we talked about rates. Hey, so people are asking where rates are going to go. Well, nobody has a crystal ball, but a lot of folks feel like with all the money that the government's printing or borrowing, 1.9 trillion if they push this deal through, right? Usually a lot of that spending in a hotter economy will increase inflation. If inflation does go up, interest rates will go up. And you think about it, if things are costing more and a bank is locked in long term at a rate for 30 years, but things are costing more, they're kind of done. It's too late with that deal, but the next rate that you're going to be able to offer is going to be higher. Rates have to go up with inflation. So if inflation increases or heats up, interest rates will increase, but it's not expected. Usually when debt goes up, interest rates go down. So when government is borrowing more money, I think they'll be at the tune of $28 trillion, then actually rates will come down, all right, or stay where they're at. So I don't predict, the experts don't predict that we're going to see any huge increase in interest rates. That being said, if you want to refinance, don't wait because we will see some volatility throughout this. Right after the election, there was a week or two there where we were seeing a 0.25% increase and decrease in interest rates over that period. So it will be volatile, but overall it's going to stay, in my opinion, pretty flat, maybe slightly a little higher. but affordability will still be there. It would take a massive increase in interest rates for that not to happen. And I haven't done the math on this, Corinne, but I saw this is a really interesting stat. Just to give you an idea of how much $1 trillion is, I mean, they're about to push a $1.9 trillion package through, right? One side of the government, with no support from the others, right? But 1.9 trillion. How much is $1 trillion? If you spent $1 million on a daily basis, $1 million. Again, if Jim and Gene got this stat wrong and I look dumb here, I'm going to be upset with them. But they said it would take 2,700 years. Is that right? 2,700 years. You would have had to start spending $1 million a day, 700 BC, to be able to spend $1 trillion. That gives you some kind of crazy perspective of how much $1 trillion is, and the government's about to spend two of those. Two of them. So it gives you an idea of the enormity of that. Going back to inflation, they don't expect inflation. Inflation's actually stayed pretty tame. The CPI, Consumer Price Index, which measures the inflation on the consumer level, rose by 0.3% in January. This year-over-year reading remains stable at 1.4%. So that's still low, right? The Fed actually has a target of about 2% a year. So we're below that. So inflation currently is not a worry. If it is a worry, then interest rates will go up. Here's another thing to think about. One thing that can drive up inflation, and could in the short term, and actually did over the last several months, is supply chain issues. So with COVID, a lot of people being out of work, different supply chains have been disrupted. Supplies haven't been able to be there. Think about this, for example, toilet paper. How much would you have given for a roll of toilet paper months ago when there's a shortage? So that just gives you an idea of supply chain issues. If there's not enough supply, the price goes up. As people are coming back to work this year and towards the end of the year, the supply chain issues will be relieved a little bit, and it should again keep inflation in check. All right. Let's see. I think I covered all my points here. Oh, interesting fact. How did everybody spend, the ones that got a stimulus check, how did they spend the money? 36% of them saved, 34% paid down debt, 18% spent on essentials, 7.7% is non-essentials, 3.2% donated. So it's just really interesting how the money was saved. In fact, I believe in the first 3 quarters of 2020, America saved more money, I think twice the amount that they did in the same period the previous year. So people have been socking money away. Good news is people have been paying debt down as well. Because why put it in the bank if you're paying 18% on the credit card? So people are actually getting better. Debt is getting paid down. So things are looking good there. What's that?
FHFA, their announcement yesterday.
No. All right. Hey, a couple things, guys. I want you to comment in this section here. Corinne's putting the survey in the caption. Get these words right. In the caption. We want to hear from you. If you're in the industry, great. If you're not in the industry, please let us know, because we're debating on whether, we have a Cleckley Realtor Relations page. I've mentioned that many times. So we're gonna repost this in that page. But we're also gonna do other industry specific topics, announcements, videos, you name it, in that page only. But if you are not in the industry and you are getting some value out of this, please let us know. If you want to hear something else each week, or when we do these live videos, put that in the comments or in the survey also, because we want to make sure it's relevant to you, and we want to know whether we need to keep doing it on this forum or just do it in our Cleckley Realtor Relations page. And as always, thank you so much for your trust if you're working with us. And anything else that I'm missing?
Connections, we partner.
Oh, we try to partner with a charity each year. This year we partnered with Connections. They are based out of New Braunfels, and they help at-risk youth, right? So they serve as an emergency shelter for youth and a place for them to stay and build some life skills and just really help these kids out. We've partnered with them. This actually their 40-year anniversary this year. We're going to be doing several events. We're hopefully going to have our volleyball tournament towards the end of this year in the fall, which we'll put an announcement out. And we'd love for all you guys to create a team, because all those proceeds are going to go to help Connections and these kids here locally. So thank you guys for showing up today. Look forward to doing many more of these. If you need us, give us a call, and have a great rest of the week. Bye-bye.